Hello, everybody. This is Professor Hassey. It's Business 635 Managing Financial Resources, our weekend update for week number 5 here this fall term 2019. A lot of things going on in our class right now. As many of you know, you've completed your first case last week, and I'm still in the process of grading it. A lot of work to grade these papers, so I apologize that, but hopefully we'll have all the grading done no later than Sunday of this weekend, but hopefully earlier than that. But look for those grades, and I will send you an email when those case number 1 grades are posted. You're also working on case number 2, which was the subject of some other information earlier this week, a case determining and doing some work on capital financing, risk management, capital structure. I've already spoken to some students about the case and will be available this weekend in case any last minute questions regarding case number 2. And remember, these cases are for you to interpret data, gather data, and interpret data. This is a upper level MBA class, and it's your responsibility to try to locate this data. I will help you if you have a difficulty finding the data. I've already aided some students in pointing them in the right direction to gather data, but it's your responsibility at this level to gather that information. Also this week we're talking about the halfway point of our class. I've already gotten some feedback from many of you about the class and its structure thus far. All great feedback, and I appreciate that. Also this week I'm beginning the process of scheduling WebEx sessions individually with each student over the next week. I've posted a schedule both in week number 5 and in the student discussion forums where you are to select a time. Tonight, Friday, I will begin to send the links to the students so you can click on the link at your appropriate time next week, and we'll talk for about 10-15 minutes about the course, about any issues you may have, about what to look forward to in the last half of our Business 635 class. So please, everybody select a time and a date for you individually to speak with me next week. It's part of the online course is to interact individually with the students. Also interact as a group. And in the second half of our class, we will be having more group discussions, group analysis in our class. But I urge you to sign up for this individual session. It is part of your class participation course grade for our class. Well, our subject for today, excuse me, I have an itchy nose. Subject for today is capital budget and risk. Now, as a prerequisite for this class, you had to take an introductory business finance class, mainly 500D, or test out or get waived from that class. In that introductory finance class 500D, you learn about the basics of capital budgeting, weighted average cost of capital, net present value, internal rate of return, investment analysis. I assume most of you know about this. Now, yes, many of you have not had finance, or finance is a foreign subject for many of you, and you might find this a rather difficult to grasp. That is the nature of our video today. To get sure you're back up to speed, there's plenty of videos in Blackboard to help you with this. This video is designed to concentrate on the definition of capital finance and analysis and risk assessment. Pages 468 to page 474 of your textbook, scenario analysis and sensitivity analysis. Ways of going about determining the risk of a particular investment strategy. Very important for you to understand this because it's the highlight of most corporate finance classes is, are we right? Is the strategy right to invest in a particular asset and to budget that return? And is the return enough? And is the risk minimal to go ahead with that asset? I like to use the definition of the first car you ever bought, or the first thing you ever bought in your life, and many of you probably haven't yet to do this maybe. But the first time you borrow money, not a credit card, but a long-term debt, or borrow money from a family member, or borrow money from an employer to purchase a car, to purchase a house. You borrow that money and you assume the risk of the cost of that loan, interest, payback. And you hope the satisfaction of buying that house, the opportunity cost of buying that house, buying that car, and what it's going to provide you in value warrants the expense and the taking on the debt. Well, this is exactly what we're doing here in chapters 9, 10, and 11. We're making an investment, and is that investment enough value for the cost of the investment? I'm going to post a spreadsheet with this video, and it's called Week 5 Risk Analysis Review. And here it is right here. It's a review of a company that wants to make an investment into an asset. First of all, what is it going to cost them to get the money? And that's chapter 9, the weighted average cost of capital. What the weighted average cost of capital is based on the capital structure of a company. In this case, the capital structure is 60% debt. Thus, 40% is the equity structure of the company. That's how they're financed. And they want to maintain this investment or this capital structure in purchasing a new asset. So that means 60% of the funds are going to be borrowed and 40% are going to come from equity. Now that could be the issuance of stock, or it could be using profits from prior periods. What is the cost of that capital? Well, for the cost of debt, it's the after-tax cost of debt. Okay, it's the after-tax cost of debt. In other words, if we have a 9% loan on some money that we owe, and we're in a 30% tax bracket, it's really costing us 6.3% after tax, because interest is deductible on the debt. Yes, we will be writing checks for interest of 9%, but when we file our tax return, we get a tax break at our tax rate, 30%. Thus, our after-tax cost of debt is 6.3%. Well, since we're 60% funded in our capital structure of debt, you take 60% of the after-tax cost of debt, and that's our weighted average cost of debt. 60% of 6.3, 3.78%. Our cost of equity is the risk and the demand for investor return in the market. That's based on three areas: the risk-free interest rate, the rate of beta of 0, 2.5%, the market return rate, which is 10% with a beta of 1.0, and the specific risk of your company in the market. In this case, the firm's beta is 1.35. Beta is calculated on a quarterly basis based on the standard deviation analysis, this is statistics, of comparing the return on the investment of the company to the market. And in this case, it's 1.35, a little bit riskier than the market of 1.0. You combine these three figures into what is called the capital asset pricing model, taking the risk-free rate plus the difference between the risk-free rate and the market return, that's called the market premium, and multiplying that market premium times the risk of the particular company, 1.35. If I put that together in a solution, my cost of equity upon the capital asset pricing model is 12.63%. That, compared to the weight of equity of our capital structure for this particular problem, is 40%. 40% of 12.63, 5.05% weighted cost of equity. You add the two together, debt and equity, you get the WACC, 8.83%. This, as of today, with the risk in the market, the tax shield of the industry, the risk in the industry and market of this particular company as far as equity is concerned, gives us an average cost. We use that average cost to determine, this is the second tab called base analysis, and we use that as our discount rate when we put together the cash flows. And this is what chapters 10 and 11 are about. putting together a capital budget estimate of an investment and the cash flow that investment will generate into the future. You discount that cash flow into the future by the WACC that we just calculated. And in this case, it's 8.83%. We put that into our formula, 8.83%, and we get the discounted cash flow, thus the NPV, and our other investment analysis, internal rate of return, profitability index, and payback. These are all discussed in Chapter 9, Chapter 10. In other words, $1 million invested in an asset is going to produce over a depreciable life of 10 years, a depreciation of $100,000 a year, with a salvage value at the end of its life of $50,000, a selling price per unit of $20 a unit, an inflation rate of 2.5% of that selling price every year, a variable cost of production of 8% per unit, changing at an annual rate of 2% a year for inflation, with a fixed cost of $50,000 a year, inflated every year after year one at 1% inflation rate, with a company tax rate of 30% and a working capital base rate of 12%, we can put together cash flow estimates for every year throughout the depreciable life of this asset. Remember, the cash flow is net income, sales minus expenses, which includes depreciation, taking out the tax, getting net income. This is our accounting net income for the project. Then we add back in depreciation. As a non-cash expense, that's added back in. We take out working capital requirements, and I'll explain that in just a minute. The bottom line, we get our net cash flow. The only difference is in year 10, when we have the salvage value, which is a profit of $50,000 at the disposal of that asset, and we reduce that by our tax rate for after-tax gain, we net some additional cash flow in the final year. This is how you project out cash flows. This is an estimate of the return of an investment of $1 million. Now, working capital is another cash flow requirement because just like anything else, when you purchase an asset, you not only purchase the asset, but you require upfront money to get the asset ready for the operations. Working capital is a percent of sales, 12% of sales. 12% of the first year's sales is $60,000 of additional capital. Thus, our initial investment in year 0 is $1,060,000. We take that into account with the other expenses, and the change in working capital each year adds another 12% to the figure, and there's additional cash flow going out for working capital until the final year of year 10 when the project is over and all that working capital is added back in as positive cash flow because now we've been reimbursed for the cash flow because the project is over. We then determine our net present value and investment return calculations, and we're done. In my next video, in just a few minutes, I will determine what is the risk analysis, pages 468 to 474, and this is what you need to concentrate on, what you're going to be working on in a future case, is what is the risk of an event like this due to certain output risk and due to risk of the cost structure and the revenue. I'll talk about that in just my next video for this week, number 5. See you in a minute.